is the Adjusting Journal Entries Prepaid worksheet. Now, when we look at prepaids, these are things where cash has already changed hands. So when we're looking at these prepaids, cash has already changed hands previously when we get to this point. There are two types of prepaids that we can have. We have unearned revenue, and then we have our prepaid expenses. With unearned revenue, money has previously been received. With prepaid expenses, money has previously been paid. So things that we look at with unearned revenue is just unearned revenue. All right, so this is where somebody has paid us and we have not performed the service yet. In Chapter 3, what we're looking at is, okay, we have performed part of that service, so now it becomes part of our income. When we look at those prepaid expenses, this is where we've paid money for supplies, or we've paid money for prepaid rent or prepaid insurance. So we previously have paid it. In Chapter 3, we're looking at, okay, we've used part of it. So what do we need to do as far as the journal entry goes there? So these are the ones that we are going to be looking at. So the first problem that you see is ABC has previously received $12,000 for 12 months of subscriptions. They have earned 2 months of income. So the biggie here is that we are looking at is that they have earned 2 months. So the first thing we need to know is how much is 1 month? And the way, $1,000, right. And how do we figure that out? Well, we look at how much they've paid. It was for 12 months. And so that means that we are looking at $1,000 per month. It says that we have earned 2 months. So at this point, what we would do is we would take the $1,000 per month, we would multiply that by 2, and what we would end up with is our journal entry is going to be for $2,000. All right? So $2,000 is what we are looking at for this particular journal entry. What we see here is what needs to come out of unearned, and it needs to go into our earned. And so what we would have here is we would have an unearned revenue account, and this would be our debit for $2,000, and our credit account is going to be something like, it could be, service revenue, or it could be subscriptions revenue for the $2,000. Now, when we look at adjusting entries, we will have one account that will come from the balance sheet. We will have one account that will come from the income statement. So what we see here for this one, unearned revenue is a liability. That's coming off of the balance sheet. That's my balance sheet account. Subscription revenue is a revenue account. That's coming off the income statement. So we'll have one account from the balance sheet, one account from the income statement on every account. All right? And so that's what you're going to see. For this one, we would be decreasing that liability because now we've earned part of that and we're earning part of the revenue. And so that's what we look at as far as this one goes. The next one says it's pretty much the same thing, but it's just saying it a little bit differently at the end. The first one told us how much we had earned, right? This one that we're looking at is telling us how much is still unearned. So we still have the $12,000, still 12-month subscription, so we still have to find the monthly rate, but it tells us that 2 months are still unearned at the end of the year. And so that's the key word that you're looking for in this one, is that unearned. So if we look at this, what we find is that our unearned amount right now is sitting there at $12,000. We need it to be how much?
10.
Nope.
I mean, sorry, 2.
Right. Now the journal entry will be 10, but we need it to be 2,000, and because that is going to be how much is still unearned at the end of the month. So when we're looking for our journal entry, we're looking for an amount over here. And so what we see is if we take that 12,000 minus that 2,000, that does give us a $10,000 amount. Now for anybody that's wondering, where did that 2,000 come from? It's the 12,000 divided by 12, right? Gives us 1,000 a month. 1,000 times 2 months is still unearned, means that 2,000 is going to be the balance in our unearned revenue account. So at this moment, what we're looking for in this unearned revenue account is we are looking for what the debit amount is going to be. And that debit amount is going to be this $10,000. So we would have unearned revenue, debit of 10,000, and our credit account here is going to be that subscription revenue account for 10,000. Again, my debit amount has to equal my credit amount. So if one's 10,000, the other has to be 10,000. All right? And the other things we look at is we have one balance sheet account, one income statement account. The reason I gave you these two different entries is I want you to see what all of the stuff looks like and what you could be told. So you could be told this is the balance in the account, or you could be told this is what I've earned. Now if you're told this is what I've earned, like we were in number 1, we said we were given how much they earned, right? So that's going to be your journal entry amount. When you're given a balance to an account, like you did in number 2, you have to find that journal entry amount by looking at the T accounts. So balances, when you're given balances, you're going to look at a T account and see what the entry would be. The next one that we see is number 3, and it says XYZ has a balance of $1,200 in their supply account. The end of the year inventory shows that there is a $500 balance on hand. So you see here we're given a balance, right? Now, the number that we're looking at, that $1,200, can come straight off of our trial balance. So that's the amount that we have on our trial balance is $1,200. So when we look at this, what we find is in that supplies account, we will have $1,200. What this is telling us is that when we went through, we counted up all of our supplies, and we found out that we actually have on hand $500. So what that means is that our balance in this account, when everything is said and done, should be $500. So we need to know what our journal entry amount is going to be. And the way we find this journal entry amount, because they're both on that debit side, what we look at is the $1,200 minus the $500, and that is going to give us $700. Okay? And so what we see with this amount here is that this is what our journal entry is actually going to be, is the $1,200. And so what we have here for these accounts, as you see, the supply account is going to be which one? What side's that on? Credit. The credit side. So supplies would be our credit. All right. What goes with supplies? If we've used supplies, they turn into what? A supply what? Expense. So what we're going to have here after we've used them is it will go to the supply expense. And so what you will see is supplies expense will be our debit for $700, and our credit will be the supplies account. All right. Anybody got any questions on this one? Okay. What you're looking at here, what did you have? What do your books say you have on hand? What do they say your balance is? $1,200, right? When you actually did a physical count, what did you actually have? 500. So that's a difference of how much? 700. So that means that I have used $700 worth of supplies, right? So I have to make sure I move that into the expense account and I take it out of the supply account.
Okay, so the supply account was $1,200, but
Yes.
since we used 500, okay.
Yes. Yes, okay? So next one that we're looking at, still a supply account, but it can be worded a little bit differently. Okay? So in this problem, it says XYZ has a balance of $1,200 in their supply account. They used $500 of supplies. Now the key word here is what? Used. Now whenever you see that, that means that this is the expense. We don't have to go in and look at the T account. We don't have to go in and look at anything because we know how much we used. In the previous example, we didn't know how much we used. We knew how much we still had. On this one, we know how much we've used. So for this one, the amount that they give us will be our journal entry amount. And so again, we've used those supplies, so those would be part of that supply expense. And it would be for that amount of $500. And it'd have to come out of supplies because we have used them. So they are no longer in supplies. Now again, we are looking at supplies. Expense is our income statement account. Supplies is our balance sheet account. All right. So what these adjusting journal entries do is they make our balances correct. That's what we're doing with adjusting entries, is we're trying to make sure that we are matching those expenses with the time period things have incurred. We have our revenues going on, when they've been earned. That is what we are looking to do with these adjusting entries. The next one that we see is looking at another prepaid expense item, and this prepaid expense item is rent. And so what we see here is ABC paid for 3 months of rent on May 1st. And they want us to prepare a journal entry as of June 30th. So the first thing that I want to look at is how much is 1 month worth. So the way I will look at this is I will come in and I will say, okay, so I have, well, I didn't write it down here, did I? In your problem, it tells you that they paid $3,600. When I was writing it on my tablet, forgot that part of it. So on your worksheet, it says ABC paid $3,600 for 3 months of rent. So what I'm going to do here is I'm going to take that $3,600. It was for 3 months. So that means that we have a total of $1,200 per month. Now, how many months are we looking at here?
3.
All right. We paid for 3, right?
2 months.
So, but it tells us that we paid for it on May 1st, and we need to do an adjusting journal entry for June 30th. So what we have here is May and June. So in looking at May and June, it means that we are going to record the expense for 2 months on June 30th. So we need to take the $1,200, multiply that by the May and June, 2 months, and that gives us $2,400, right? So now what we know is that is what our journal entry is going to be for. Now, what expense have we incurred?
Prepaid rent.
Okay, prepaid rent is where we put it, but what expense are we looking at? Rent expense, right? So we have to increase our rent expense by this $2,400 because now we've paid for it and we have used it. So this is what we're showing for. In that first entry that we did on May 1st, we showed where we paid for the prepaid rent. Now we are showing that we've used part of this prepaid rent. And so we are at rent expense, and then we look at the amount that we've used. And so we'll have prepaid rent for $2,400. Now, what amount do I still have in prepaid rent after this entry is done? $1,200, because I still have 1 month's rent that I have not used yet. Okay? You guys see that? So I've used 2 months. I still have 1 month that I have not used. So this is where it tells me how much I paid, and I have to figure out how much I've used. The next problem that you see is number 6, and it says XYZ paid $6,000 for insurance, but it tells us that $2,000 has expired. Now that word expired, what it means is it means used. So if you see the word expired, this means this is what we've used. This is what the expense is going to be. Okay? So if you see the word expired, that lets you know that's what we've used. That is our expense. We don't have to figure anything out here. That is what we have. So in this particular case, if we have used $2,000 of insurance, what would my debit account be?
Insurance expense.
Insurance expense. And that'll be for that $2,000. Now, what is my credit account?
Prepaid insurance.
Prepaid insurance. Because I'm taking it out of that prepaid account. And so what I would see with this particular one is that my prepaid insurance account would now have $4,000 in it. Because I had $6,000, I've used $2,000, so I'm left with $4,000 is what my balance would be in that prepaid insurance account after this entry is finished. Right. Now, if I had been told, and if you see the word unexpired, guys, unexpired means that is the balance in the account. All right, so expired means that's what we've used, that's the expense. If you see the word unexpired, then that would be what you'd be looking at for a balance, and you'd have to look at the T account to figure out how much you had used. Okay. The last one on your worksheet says depreciation for each month is $100. Prepare a journal entry for 3 months. So what would we do here?
Oh, we don't know what depreciation.
Okay.
What are we depreciating? 100 by 3.
Okay. So the first thing we need to look at is how much, right? All right. So yes. So we do have 100. We multiply that by 3, and we know we are looking at 300. Now it's telling us depreciation. So some new accounts that we're going to look at here are depreciation expense, and this is where we allocate the fixed assets. So up until this point, we have just purchased equipment, or we've purchased, desk and furniture. We purchased buildings. We've purchased those types of things. In this chapter, we start allocating those across however many years and what their useful life is. So if we had a building, it might be allocated over 27 or 40 years. If we have a piece of equipment, depending on the piece of equipment, it could be allocated, and we could say it has a useful life of 7 years. So we would have to depreciate over 7 years. When we get to chapter 10, we are going to look at how to figure out the depreciation amount. Okay? In this chapter, all we're looking at is they're going to give you the amount, and then you have to do the journal entry. So the journal entry that you are going to see is actually going to involve 2 new accounts. And the first account is that depreciation expense account. So that is going to be a debit for that $300. The second account that you would see is something called accumulated depreciation. Now, accumulated depreciation would be our credit account. And what accumulated depreciation is it is a new account that's called a contra account. And what a contra account does is it holds the opposite normal balance from the account it goes with. Accumulated depreciation is a contra account to our fixed assets. So we could have a contra account to buildings. We could have a contra account to furniture, a contra account to equipment. And so it would be accumulated depreciation equipment, accumulated depreciation building. So you could have separate accounts. Lots of times in practice, we don't have separate accounts. We have one accumulated depreciation account when we actually are working. But in what you're going to be looking at, some of those things are going to want you to name it accumulated depreciation equipment, accumulated depreciation vehicles, and things like that. So you will see those types of things. The way it works on your balance sheet, all right? So if you have your list out, and we'll learn a little bit more about this and as far as how the balance sheet is classified in Chapter 4. But you would list your fixed assets. So you would have things like buildings, equipment, supplies would go under what we call current assets.
Oh, because we only use it for that one.
Right.
And this is over a period of time.
Right.
Kinda
These.
like the computers you were talking about?
Yes, kind of like the computers I was talking about last week. Yes. So what we see here is that we would list these things out, and so we might list them out and say buildings are worth, $100,000, equipment is worth $10,000, we have vehicles $20,000, and then we would come underneath it and say, okay, less accumulated depreciation of, let's just say, $10,000. And then you would come up with a total fixed asset section. And that total fixed asset section would add up all of your assets, and it would subtract the accumulated depreciation from it. And so what you'd be looking at is roughly that $120,000. So you're getting the net value. Now you may look at it and go, well, why don't we just take it against buildings? And why don't we just take it against, vehicles or equipment like we did with supplies and like we did with prepaids? The reason is we have something called historical cost. And our historical cost principle states that we record our purchases for fixed assets at their cost. And they have to stay at their cost. So if we purchase a building for $100,000, it will be on our books at $100,000 forever until we get rid of it. Okay? But there has to be a way that we allocate the expense over its life. And the way that we allocate its expense over its life is through depreciation expense and the accumulated depreciation. So we just back that out through accumulated depreciation, and we never touch the actual fixed asset account. So you are not going to debit or credit. You'll debit the asset whenever you purchase it, okay? But you're not going to credit it unless you're selling it and getting rid of it. It will be the only time that you will ever look at crediting one of these items. All right? Does that make sense? So that is the prepaid side. Now we do have other sides that we can look at, but that is that prepaid side of adjusting journal entries.